let's talk about the aspect of doing some securities research. There's two different kinds of research. You may recall there's primary research, which is research that you do yourself, and there's secondary research where you go out and see what is the most appropriate out there in the market that relates to what you're doing, but may not be exactly what it is. Pretty much on this research, you'll be doing both of them because it's about you. Probably the most famous place to see stock is actually on the NASDAQ price wall. It's right there in New York City in Times Square. It's a giant different map over there. Whenever you see somebody talking about stock, you'll always see this whole thing with the numbers rolling on by it. It's kind of a cool thing to look at, but it's almost like the icon of everything in the stock. You'll see the NASDAQ exchange. You recall NASDAQ is a lot of it where you're out there and they're doing over-the-counter stock. Some of the research places you look at, the Bloomberg Reports is a really good one. Forbes, MS and Money, The Street, a good online aspect of it. Dow Jones is actually the Wall Street Journal, the Motley Fool. My two favorite has always been really, I look at Forbes, I look at The Economist, I look at Dow Jones and the Motley Fool. The Motley Fool has some really good aspects into it. I enjoy it, except they're always hawking their own version of what they think their own portfolio should be. So I'm always cautious when everybody's selling a product, and miraculously their product will make you rich overnight. If it makes you rich overnight, why are they selling to somebody else, not using it themselves? That's kind of always the concern I have. Anyway, so when you invest in bonds, you've got to look at the maturity, sell your bond before the maturity date. You may have to sell at a discount, but maybe you'll sell it at a premium. Okay, you may be able to sell the premium, the interest rates go up, the bond prices fall. That's the kind of risk that you're dealing with, the maturity aspect of it. The risk overall is somebody's going to look at the overall risk because people out there, you're dealing with a lot of sharks and they're looking to make money. And a lot of times in this industry is that one person wins, one person loses. You don't want to be the person that loses. Okay, so you want to make certain that you're buying well and selling well as well. On the risk, the higher the risk of a bond, the higher the interest rate the insurer has to offer to be able to sell it. If they're not, then you'd be paying a discount for that. All this stuff has risk to it. We talked about junk bonds, B and below, we consider to be junk bonds. They have high default rates. There's a reason we call them junk because, well, they're junky. They sometimes don't pay up and all of a sudden may lose all the money you put into it. Mutual funds are very safe, but you're going to be paying a fee to a mutual fund manager. Make sure you know how you're paying that. They buy stocks and bonds. They have a portfolio. If you have a mutual fund, let's say you have an Asian mutual fund, okay, which is something that I have. So it's focused in on primarily Asian stocks and bonds. And so there's a portfolio, there's like 75 different items in there, and they're shifting all the time as to what they're buying. And they may have one item going out, one coming in, one going out. So you see a whole portfolio, one mutual fund. You can put $100 into mutual fund and have, you're buying a share into the mutual fund as a whole, and all of a sudden now you have a much more diverse fund all of a sudden with just one investment. Now, to be honest, mutual funds, they don't make massive amounts of money. You can make more money doing other things individually, but if you're going to be not paying attention to your daily portfolio and watching it on your cell phone all the time as to buy, sell, buy, sell, buy, sell. If you just want to put money into a pretty decent investment, find your portfolios of mutual funds, your different ones. This is a good way to pull it, especially if you're not paying attention. We'll talk about some of the danger coming up about stocks shortly. It's a fun pool, so you have a lot of people. Some mutual funds have millions of people involved buying their funds. Some of them, it just shifts between the different aspects of it. You can buy mutual funds into real estate, mutual funds in high-risk securities. There's different things, and you'll see the definition of it. And by the way, you already know it's going to be inside the actual document, your prospectus, and because the mutual fund will have the prospectus as well with it. Mutual fund objectives sometimes is right in the title. Over here, investment grade corporate bonds. Let's see, AU, gold oriented. G, AU is the element symbol for gold. Gee, it's not rocket science to figure that one out. And a balanced one, balance between stocks and bonds. They'll give you a lot of definition once you get the prospectus, but the reality is a lot of time is you'll see emerging markets. What does that mean? Well, go get on the internet and take a look. What does that mean? European region. Well, let's see. It sounds like it's European. Okay, so some of the stuff is not rocket science to figure out. It's pretty simplistic in the title, but regardless, Pay attention to what's in there on your prospectus. Healthcare, biotech. What exactly does that mean? Biotech sounds like they're using technology and actually the interaction with humans that could be very interesting. It depends what you're interested in. Over here, municipal bonds. Here's another mutual funds. They're all focused on municipal bonds, large cap, large capital growth, large capital core, Latin America. They have the titles are right there. Here's some small cap cores. By the time you're done, you look at those. So pay attention to what's out there. Really, one of the better ones out there is the S&P 500. Okay, Standard & Poor's 500. They invest in the top 100 stocks. It's pretty straightforward because there's a title right there. So a lot of times when you buy into these different funds, you'll have that. Another one, it's like a mini mutual fund. Mutual fund will have dozens, sometimes hundreds of different types of investments in them. ETFs are much smaller. They're a collection of stocks are traded, but instead of being traded like individual stocks, they're more like mutual funds because there's 5, 6, 7, 8 in a very specific area that they might have maybe a dozen that are all focused in onto this technology stocks. And you're over there and you watch it. And so they'll move faster than you will have in a mutual fund, which is a little bit slower than ETF. That's an interesting way of buying. When you're comparing investments, here's a good chart. Okay, the degree of risk bonds is low, but you don't have they're secure because you're getting the interest coupon rate on a regular basis. Okay, there's probably not much growth in them. Okay, because they're going to have a maturity date on them. So preferred stock, then common mutual funds and ETFs. Here's your degree of risk. This is just a chart, but sometimes you can make an awful lot of money off some of the different aspects of it. It depends what it is. Pay attention to your different kinds of security, mutual funds, ETFs, common stock, preferred stock, junk bonds. Mutual funds would be an assortment of different funds. ETFs is a smaller version of with a highly focused group of stocks. Common stock has voting rights and has ownership in the company. Preferred stock doesn't have ownership in the company and it acts an awful lot like bonds. And then junk bonds, they can pay an awful lot of interest, but also you have to worry about the fact that if the company is going to be around tomorrow, because a lot of times a junk bond is a last ditch desperation effort by a company to survive. Sometimes it pays and sometimes not so much. Take care.